Most investors don't lose money because they buy the wrong asset. They lose money because they sell the right asset at the wrong time. Think about this. You spend weeks researching a stock. You finally buy it. A few days later, it's up 15%. Suddenly, your brain starts whispering, "Take the profit before it's gone." So you sell. Then, 6 months later, that same stock is up another 200%. Sound familiar? The uncomfortable truth is that the biggest enemy of your portfolio isn't the market, it's your own psychology. Throughout market history, this pattern repeats itself over and over again. During the 2008 financial crisis, investors rushed to sell quality companies at massive losses. During the COVID crash of 2020, fear forced millions of investors out of their positions near the bottom. Yet many of those same assets went on to reach new all-time highs within the next few years. The market changed. Human psychology didn't. Researchers at Dalbar have consistently found that the average investor significantly underperforms the market over long periods, not because they choose terrible investments, but because they buy and sell based on emotion. And this is where things become fascinating. Your brain experiences the pain of losing money far more intensely than the pleasure of making money. Psychologists call this loss aversion. A 20% gain feels good. A 20% loss feels devastating. So when an investment rises, many investors rush to lock in profits. But when it falls, they panic and exit entirely. The result? Small wins, big mistakes. Now consider the difference between gold and Bitcoin. Gold has spent thousands of years building trust. Investors view it as stability. Bitcoin, on the other hand, regularly experiences declines of 50%, 60%, even 80%. Mathematically, both assets can generate strong long-term returns. Psychologically, they feel completely different. Most people can tolerate holding gold through uncertainty. Very few can tolerate holding Bitcoin through extreme volatility. That's why investment success isn't just about picking the right asset. It's about having the emotional strength to stay invested. Imagine planting a tree. You wouldn't dig it up every week to check whether the roots are growing. Yet investors do exactly that with their portfolios. They monitor every price movement, every headline, every market prediction, and then they wonder why they're stressed. Here's what many investors never realize. The biggest gains often occur after the most uncomfortable periods. The investors who build substantial wealth are rarely the smartest people in the room. They're usually the ones who remain disciplined while everyone else is reacting emotionally. So before selling your next investment, ask yourself one question. Am I responding to new information, or am I responding to discomfort?